Thanks, Jeff.
With a swag bag.
Yeah.
Great seeing you.
So this is being live streamed, right? Okay, yeah. So it's
Putting the
the
Seattle advertisement up there for video and camera purposes.
Yeah.
So I'm excited to chat with you again. We did this about, I don't know, 5 months ago, where we just had a great discussion, and I really enjoyed interviewing you and thought you were really candid and open and transparent. And I said, Jeff, why don't you come up from Silicon Valley and we'll do it in front of 700 of our favorite friends in Seattle.
Excellent.
Instead of a smaller group. But I know you're a big sports fan, and I know you're a Cardinal fan, Stanford Cardinal.
That's what you're going to open with.
So what happened on Friday? 44-6, our UW Huskies took care of some business, didn't they? Yeah.
Yes, they did.
That was pretty awesome.
Big, and by the way, Mr. Lockett on here with the Seahawks, who also took care of business against the Niners, which I go to. No, I'm a huge Stanford football fan. So the week before, I was honorary captain of the football team in their game against UCLA at the Rose Bowl. So I got to do the coin flip, and Stanford won this with this late comeback. There is a video of me. The coaches sent it. They were looking at their game film, and on the winning touchdown, there's this little idiot in the bottom quarter on the sideline jumping up and down frenetically. And the coaches looked at it and go, who is that? And he goes, oh, that's the honorary captain, Jordan. So they sent it to me. So my game, they won. Ballmer's game, he was the honorary captain at Washington. I don't know what the hell Steve was doing.
Yeah. Nice. Well, it does kind of dovetail on a question that I had for you, which we talk a lot about, and Craig Sherman kind of mentioned being in Silicon Valley and Seattle. What do you make as a Silicon Valley venture capitalist who's done a number of deals here in Seattle about this rivalry, if it is that, between Seattle and San Francisco, whether it is a rivalry or whether it's just, what do these ecosystems have in common, and how do you look at these two cities?
I mean, for me, I don't really sense a rivalry, but I sense a very vibrant ecosystem up here. I will, not intentionally, I just did my 4th deal in Seattle in 5 years as a venture firm. So it's, we've been very pleased with the quality of the company. We were investors in Zulily, in Julep, in OfferUp, and now in Accolade, Roger Singh's new company. And so what we're finding is an entire ecosystem where really interesting companies can be built. There's the engineers to support them. There's the capital to support them. There's the lawyers. Craig, thank you for all your efforts to support them. It is an ecosystem in which we're very comfortable investing, and that's probably not the case of a lot of other cities around the nation.
Is there much difference between the two? I see a lot of blurring here, frankly. I mean, now we have offices for Airbnb and Pinterest and Facebook and Twitter and Dropbox, and the list goes on, setting up shop here. And there's Valley money coming in. Is it that big of a deal? The rub on venture capital in Silicon Valley for the longest time is you wouldn't live within 30 miles of Sand Hill Road.
That actually we had to now, because all the consumer companies have moved to San Francisco, and that's about 35 miles. But it's
probably faster to get to Seattle on a flight.
It's slightly less convenient for me. I can do 2 or 3 board meetings a day. When I come to Seattle, I typically do 1 a day, so it's a little less efficient. But you go where the great companies are, and hopefully they're. We don't do a lot of international investing, so doing a Seattle day is not at all onerous, at least for 2 months of the year. Sorry.
Yeah. So you said 4 or 5 year deals are up here. Have you seen a different culture or personality or style of the company that's here in the Northwest versus the Bay Area?
No, and that's actually the attraction.
Okay.
You don't see a different style. One of the noticeable things you often see in companies outside of the Valley, the Valley is unique in that there is a pace to play that somehow is in the water that a lot of entrepreneurs get, and the amount they expect to accomplish in short periods of time is very high. There are many other places where we don't see that same, there's something that's almost like they didn't get trained that's the expectation. In Seattle, that is the expectation we're finding. I couldn't tell you the difference between the entrepreneurs in the 2 locations.
Great. And I know you've spent a lot of your time studying marketplaces, being involved in marketplace businesses, whether it was eBay or OpenTable. What is the attraction of that type of business for you first as an operator, but now as a venture capitalist?
I mean, I love marketplaces, and the biggest reason, I mean, one, they're just inherently fascinating. So eBay, I took microeconomics in college and loved that class, which will tell you a lot about me. eBay was applied microeconomics every day. I mean, just managing supply, demand, perfect competition, the whole thing. So one, it was fascinating, but much more from a business and investor standpoint, there is defensibility inherent in most marketplaces. Network effects are a wonderful thing, and winning marketplaces typically develop network effects. So eBay had network effects. Network effects are, the service gets more valuable the more people who use it. So eBay had all the buyers, so the sellers came, and then they had all the sellers, so all the buyers came. It rolled up. PayPal has network effects. We believe Airbnb has network effects. More hosts make it more attractive to guests, and the hosts go to where all the guests are. So our bet on OfferUp is that they have network effects. So that's the unique contrast that with like e-commerce companies. There are no barriers to entry other than Amazon has this massive scale advantage, but I am unaware of an e-commerce company that has a network effect, and that means it's very hard for e-commerce companies to get profitable. And I can think of in my career I've seen 3 U.S. large e-commerce companies that had any profitability at all. And I was investors in 2 of them. I missed Amazon.
What were the other 2?
Zulily and Fanatics. Fanatics has licensed sports merchandise online. And their mode is they have exclusive deals with all the leagues.
Yeah, and you told me in a previous conversation that you find it hard to compete in the e-commerce or retail business. You're kind of staying clear of that.
I mean, it's what we're finding is a business where you have to acquire users that doesn't have defensibility means that you're quickly competing with like concepts to acquire basically the same user. And what happens is, what we've seen is the acquisition costs get much higher. It gets much less efficient. At the same time, competition's pressuring your pricing. So, I mean, e-commerce is a business that has low barriers to entry, and as a result, you're seeing, vicious competition for customer acquisition and an inability to raise prices, and as a result there's just no profits coming out at the other end. Yeah. There are other businesses that have those same characteristics, and we're getting increasingly leery of that model.
Yeah. So on kind of the marketplace topic, continuing on, there was some pretty big news this week with Facebook Marketplace.
Who?
You heard about this company? Yeah, and potentially a competitor to OfferUp, one our Bellevue-based company here, which you're on the board of. What did you make of the Facebook? Yeah, there's the blatant ad. What did you make of the Facebook announcement and their ability to create a very successful marketplace business?
Yeah, I thought Nick answered that very well in his session. You pay attention to what Facebook's doing. How can you not? It's one of the most talented entrepreneurs with one of the largest resource pools around, and lots of engineering talent. This is not their core business. They have played around in e-commerce before without a lot of success, but you take it really seriously. I think the opportunity and the challenge for OfferUp is the fastest growing business I've ever seen. I mean, I had the privilege of being at eBay. I had the privilege of being at a lot of, on the board of Airbnb. This is the fastest growth I've ever seen in consumer spending in a business. It's up to the company to use that strong growth early lead to continue to innovate and build a great service. You have to earn the privilege to be a market leader, and towards that end, anyone in engineering who's looking for a great job, OfferUp is hiring like crazy. You get to compete with Facebook.
Well, I mean, you do get to compete with Facebook. They have a massive user base. It's still, I mean, it must be scary as an entrepreneur or an investor to hear that either a Facebook or an Amazon is moving into your turf.
If you're doing a great job and growing a really interesting business, you will draw competition. I mean, it's a certainty. And so, that happened at eBay. When I first took over operating eBay, Amazon and Yahoo both launched auction businesses. Both were big companies, particularly Yahoo was a big, scary company. And eBay buried them. eBay had network effects. So, and I'd like to think we executed well as well. So just being big, when I was at PayPal, Google launched Google Payments. I mean, a company that Larry Page calmly says, I was trying to convince him not to do it. And he's like, yeah, we'll probably do it ourselves instead of use PayPal, and we'll probably fail because you have network effects, but we'll just throw a little money at it. $500 million later, PayPal was able to bury Google checkout. So, I think the importance is have to execute at a high level, have to earn it.
So how do you pick either entrepreneurs or pick companies that are on the fringes of these giants of technology that they aren't directly in their crosshairs, but they're a big enough business? How do you do that?
What seems to happen over time, this happened in the V1 of the internet and V2 companies in the internet, is expanding appetite as growth slows in your core business. So people start looking outside of their core business for growth. I mean, Amazon's done it brilliantly. I remember when it was the world's largest bookstore. Then I happened to be running a business a now defunct business called Reel.com, the other Reel, not the Seattle Reel. It was an online movie store. Yeah. Amazon ended movies, end of Reel.com, and then
they've done that with a number of companies.
Cloud computing, voice-enabled, the Echo and Echo Dot's freaking brilliant. And so what happens in all these companies that get more expansive? You look at Google, they've got things, debuted the phone today, the Pixie or whatever it is, Pixie. Everyone gets more expansive. So if there is a great idea, it's going to attract interest from startups. It's going to attract interest from incumbents. It is incumbent upon the startup to execute.
So who's the most feared incumbent right now in the tech industry?
I forget. There's a cute little acronym. There are 4 of them right now. So you've got Amazon. In the stuff I do on the consumer side, I blogged on how you try to avoid anything Amazon's doing. Google, Facebook, Apple. And they are, in different segments, they're there, but they're typically founder-led, Apple till recently, but the founders there, the person who did the core innovation, got product market fit, continues to work, it continues to, and with the resources that most of those companies have given their business models, particularly Facebook and Google. I mean, the 50% operating margin business lets them hire as many engineers as they ever want and need. So we pay a lot of attention to that short list.
Yeah, no Microsoft.
Not for what I do.
Yeah.
I do consumer small business investing, and so no.
Right. Talk about the B word, bubble. Are we in one? And what does it look
we
like
might have
if we
been in
are?
one. I don't know what's happened lately. The fundraising environment up until about a year ago, particularly the late stage environment, had gotten quite frothy. There were deals were getting done with bigger deals were getting done quicker with less diligence, and by what's historically been a non-traditional set of investors. Historically, tech companies would go public within 7 years, so they only needed so much capital. Now that public offering is being deferred, I think on average to 10 years or even more, and so. And during that time, their high growth phase, there is need for a lot more capital. And so historically, that capital never structurally emerged. As companies stayed longer, a combination of mutual funds, hedge funds, sovereign wealth funds, oligarchs started writing those late stage checks, filling that capital void. Many of the deals had very onerous protective terms that gave them that reduced the risk of the deal to them. But there were some eye-popping valuations and eye-popping size of rounds. I've got 2 companies that have over $1 billion on the balance sheet, in cash. Just because
Airbnb
and why not?
Pinterest?
That would probably be good guesses. Yeah. So, that capital was available. As of about a year ago, that capital slowed down. And I think it was precipitated. There had been a little divergence between the multiples that public companies were trading at and the multiples that late-stage private companies were trading at. And then the public multiples had a shock. And I think everyone looked at the private multiples and said, that disconnect is huge. And so not many deals happened for about a half year in the late stage. And only the very top entrepreneurs at really interesting companies were able to do outside capital. That's thawing a bit. The value, as people figure out the new in valuation. So we are seeing deals get done. They're not at the same prices typically as they were getting done, but the market markets tend to be resilient, but what we stress with our companies is, you can't. A lot of the entrepreneurs we work with had only raised money in an era of free capital, and that's a great era to live in. If I'll spend $150 million and raise next month. And that is not the traditional way capital raises have gone. So we worked a lot with our companies that your operating assumptions have to take into account the fact that there's not you can't
Infinite
assume
capital.
unlimited capital on great terms.
So where are we at now, do you think, as we're maybe heading into 2017?
I mean, we're seeing kind of the market, I think, is kind of stabilizing, probably at a different prices. And entrepreneurs are actually typically are acting quite differently. You had a really tough decision to make in an entrepreneur if you're competing with other companies that had a lot of capital. You either went for growth at all costs and ran a really high burn, or you said, okay, I'm going to try to build a structurally long-term business with positive unit economics. The risk if you did the latter, if you had a competitor who was doing the former, is they would just grow you out of the market. As long as they could continue to raise, they would win. You only win if you did the profitability route. You only won if the growth guy couldn't raise, and so it was a really tough choice to make. Now I think the two strategies are converging a little more. It's kind of you want to grow, but it want to be smart growth.
Yeah. So a good time to start a company, you think?
It's always a good time to start a company. I mean, typically, a lot of the best companies have been started in the worst current markets because. Competition doesn't get funded, and you only have to worry about the markets 5, 10, 15 years later, so you can't time the market.
You took OpenTable public in one of those markets,
in 2009.
You thought it was an advantage, right?
Yeah,
doing so.
We took OpenTable public in May 2009 in the depth of the financial crisis, and there's actually a Stanford Business School case written on it, like what the hell were they thinking kind of case, and it was pretty simple. The number of public companies was contracting dramatically. The investors who invest in tech companies, that was contracting dramatically. They hadn't had any fun in a couple of years. Their funds were getting killed, and there have been no IPOs at all. I think we were the first venture-backed tech IPO in a number of years. And so when we went out and talked to them, they were just so happy to have something new to talk to, and they appreciated the quality of the business model. So it actually ended up, unusually being a very successful deal in a terrible market, partly because there was no competition for the investor attention and appetite, and partly because it's a really good business.
Yeah, and we've seen a little bit of a rebound, I'd say, in the IPO market here in the Seattle area. We've had Impinj and Aptio go public.
We're investors in Aptio.
And Aptio is one of yours, and Twilio's been a good success as well. So are you thinking that's looking like that window's opening for more IPOs?
I mean, it feels like it's opening a little bit. What typically happens in IPO windows, and one of the reasons we went out at OpenTable, is early in a window, the best companies go out. The ones who, kind of like, okay, I was confident OpenTable would perform well with investors, so we were the first to go out. Then the medium companies go, and then late in the window, it's typically the lower quality companies, and the bank who took us out, who happens to be one of your sponsors, B of A, when they were Merrill, gave us an analysis saying, here's the returns by when in a window the companies go out. And I think what had happened in the last year or two is you're at the end of the window, and the companies going out weren't the highest quality companies. I think you're beginning to see very high quality companies go out again. The window's open, it's a recycle. But the one thing it's really hard to time the market, and both the M&A market and the IPO market go through seasonal highs and lows. I mean, it was 18 months ago, people were saying no one's ever going to do tech M&A again. There were just no small non-private equity tech M&A deals because valuations had gotten very, very high, and public companies were under pressure from activist investors, and they couldn't take the dilution. As valuations recalibrate, you're seeing a resurgence of tech M&A as a lot of the incumbents say, oh my goodness, we missed the new innovation cycle. We need to catch up.
Yeah, and some of those big companies, you said those four
Yeah.
big
I
big
would
guys
add
have a lot of
Microsoft
cash.
on that one. I'd add Microsoft on that one.
Yeah,
So
they actually have a lot of cash
Yeah.
to spend, so seeing activity there pick up. So let's talk about Airbnb. You're on the board of Airbnb. You said when you first heard about it, it was one of the silliest ideas you'd ever.
Actually, I said stupidest. Yeah.
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 Stupidest?
Yeah. I told the founder that. We laugh about it now.
And now you're on the board.
Yeah. You know what was funny?
What changed for you with that company, which is obviously now massive market cap?
I love my privacy, and the concept of staying in someone's apartment or having a stranger stay in my apartment is not intuitively appealing to me. So that was the origination of the comment. About 5.5 years ago, before I was a venture capitalist, I saw Brian Chesky, the founder, present Airbnb at an investor conference. And I'm like, oh, this should be entertaining. I'm in the back row. And it was deja vu all over again. He was presenting eBay. Different vertical, different thing, but community-driven model started with a quaint little idea that seemed small. The community took it and it expanded the idea. Economic empowerment for the supply side, huge trust and safety hurdles to get over. I'm just sitting in the back going, oh my, I went from complete skeptic to complete believer in 29 minutes. I mean, it was just, and so I went to the banker and I go, I gotta meet this kid. I mean, he was, I've seen the future, I've been all this. And it's funny, he asked to meet one person at the conference and it was you. And so when I met Brian, I'm like, what was that? And he goes, oh, I got the eBay thing. Yeah, I got it way before you did.
Yeah.
As a result, incredible entrepreneurs, built an incredible team, and it's a pretty spectacular business.
So earlier today, we heard from Expedia CEO Dara Khosrowshahi, and he was making the case that Expedia has a bigger play field, essentially, that they're in because they do both the traditional hotel bookings, plus they have HomeAway and VRBO, and they like their position as it relates to Airbnb. Give us the flip case on why you think Airbnb might be in a bigger,
I think Dara's
or better position.
I think Dara's done a really nice job. In a consolidating environment between Priceline and Expedia, there seems to be a lot of consolidation going on. I think Airbnb is a unique business. I mean, and it's taken me a while to fully appreciate it, but for me, the current ad campaigns kind of capture it. It's like live like a local. You are not the value for me in a hotel is it's a consistent experience. It's no friction. It's a gym. It's all those things, and I don't have to talk to anybody and all that. When I go on vacation, I actually like to talk to people. And so the concept of we were over in Kyoto with my son, and we lived in a neighborhood in an Airbnb. You walk to the corner ramen place. You're meeting people. You live like a local. So it is a very different use case. It's primarily at this point pleasure, not business. Where hotels are primarily, in most cases, primarily business, not pleasure. But Airbnb, it's got a user base that loves it. It's showing all signs of network effect. It's at hyper growth in spite of it being at very large scale. I mean, it is a global phenomenon. Airbnb had got active business in every country of the world, in every major city of every country in the world but 3. One is North Korea, can't do business there. I think another one's Syria because of the civil war, and I'm guessing the last one is Iran because of sanctions. But they just opened Cuba. Airbnb is the biggest accommodation place in Cuba now. At the Rio World Cup and Summer Games, something like 25%, 30% of all visitors were staying in Airbnb because the hotels lack capacity. I mean, it is unlike anything we've ever seen. Yeah.
So do you think Expedia can make that transition into that business, or are you gonna at Airbnb move kind of into Expedia's world?
A lot of Expedia's business is in traditional flights and hotels. I don't think you'll see Airbnb compete in that world.
That was Dara's question. I asked him what question I should ask you, and he said, would Airbnb ever expand into traditional hotel bookings?
I mean, I think the Airbnb team believes they're just getting started on what they do well and what they're differentiated at. And I think Brian, Joe, and Nate and the team is looking to, how do we fulfill the promise of what they've started? Because, I mean, we've only been investors in 5 years, and when we invested, it was hundreds of millions of dollars. Now it's tens of billions of dollars.
They just raised 550 million.
That was the
roughly?
report. Yeah. So I mean, we're extraordinarily enthusiastic about the potential for the business.
Why would Airbnb go public? I mean, of course, at some point, but why aren't you pressing for them to go public?
You should ask the company. I got in trouble in a recent interview. They are a company that will go public. They're picking their timing.
Great. So what are the 2 or 3 characteristics that you value the most when you look at entrepreneurs? You mentioned Brian Chesky, the founder of Airbnb. What stood out about him or Nick Huzar at OfferUp? Or what are those personality traits that really stand out to you?
I mean, there are a couple that we really look for. The key decision you're making as an early stage investor is the entrepreneur. The key decision actually you're making as a late stage investor is largely the entrepreneur. One is things don't always go swimmingly in startups. I was having dinner with Mark Andreessen Monday night, and he was recounting that Facebook has faced 4 or 5 relatively existential growth crises in its history. Where growth really stopped, and they're all like sitting there like, it's not, the hamster stopped running. What happened? And at one of those times, Yahoo was trying to buy it, and all the management team and a lot of the board said, "Sell, sell. There's no growth. You've got a dead shark." And Mark Zuckerberg had the courage and the belief to persevere through that. So the most important attribute for us in an entrepreneur is that perseverance and courage.
Grit, which is one of the themes here today.
I mean, it just is hard, and you wake up one morning and Facebook launches. Whatever it is, it's going to be hard. So perseverance and courage. Another that I actually talked a little about is the ability to tell a story. You actually, and a professor at Stanford, Jennifer Acker, had a class in this that she was kind enough to ask me to attend. But she asked me to say, okay, how does storytelling affect investing? And the best storytellers in my portfolio are the best entrepreneurs and are building the best companies. Because you're telling stories to hire your employees, you're telling stories to get capital, you're telling stories to get partners, you're telling stories to make the press be interesting. The ability to persuade and weave that in is fascinating. So the Airbnb founding story is unbelievably compelling and interesting, and when Brian or Joe tell it, you're kind of leaning forward like, really? Yeah. But we have the same thing in Lookout Mobile Security, Ben Silberman at Pinterest, Nick at OfferUp. They all can tell their founding story and other stories incredibly well, and basically influence people to help them accomplish their vision.
Yeah. So Andreessen Horowitz was in the news recently, Wall Street Journal report, saying that the firm wasn't at elite status, I think was the quote that they used, because of the returns of the firm. What did you make of that report, which was comparing you to some of the other firms in the Valley, Benchmark, Sequoia, whatnot?
One of those very interesting stories that you're kind of like, what do you do with that?
Well, you came up with a pretty blistering response.
Well, it was a very constructive, measured response, yes, but by our managing partner, Scott Cooper. Essentially, venture is a long lead time, long return business. Our firm's only 7 years old. So the fund with the most history has performed quite well, thank you. So it's doing well, and each of the subsequent funds is performing well. One question you have in valuing illiquid securities prematurely is, what approach do you take? We typically take a conservative approach. I think what we were most gratified by when you get a little tacky story like that, our LPs were unbelievably supportive. They reached out and they're like, I don't know what that's about, but we just raised a $1.5 billion fund. That would suggest, we didn't add any new LPs. That would suggest our LPs are actually kind of happy. And so we will let the track record as it evolves over time speak for itself.
And as we've said, you have a lot of companies that are in the pipeline that might be on the path to go public. So an Airbnb or OfferUp even, or Yeah, Pinterest. So definitely some path to success there. So before we wrap up, I do want to ask you, being entrenched in the Valley and Valley lore, do you watch Silicon Valley?
Yes,
the
I
show?
do.
Okay. Does anybody out here watch Silicon Valley, the show? Yeah, about more than a quarter. So what do you make of it in terms of its satire? Is it on the mark?
It's on the mark. It's satire. It's incredibly entertaining. Particularly, we're immersed in it for 12 hours a day or whatever it is. The people they are lampooning who have celebrity, they do an incredibly good job of. Just the average.
Have you been
run-of-the-mill-
lampooned yet?
No,
Yeah.
I'm not a celebrity, so it's excellent. The gentleman who played Peter Thiel, who unfortunately passed away,
Yeah.
I thought was brilliant. I mean, just a brilliant portrayal of him. The guy running Hooli is
Because you worked
spectacular.
with Peter Thiel
Yeah,
at PayPal. So you know him.
and he's, couldn't hold him in higher regard, but that was a pretty interesting portrayal of him. The Hooli guy, the Ehrlich, the engineers, who are completely, socially
Messed up.
some of them, yeah. So no, I think it's absolutely brilliant. The only show I like more these days is Billions. I've been binging on that.
Okay. So who's your favorite Silicon Valley character?
Oh, it's got to be Ehrlich. Ehrlich's just,
Ehrlich.
just tremendous.
Cool.
Yeah.
Well, good.
I aspire to be like Ehrlich, can't you tell?
That's right. That's right. Well, I really appreciate having Jeff Jordan here from Andreessen Horowitz. Let's give him a big round of applause. Thanks, Jeff. Yeah.